I need so that I can share some information with you. Okay.
Okay, sir.
All right. Because some of the things we'll be sharing it there. Fine. Today, we want to continue our lecture and on financial market institution. We'll come back to a bit of to when we meet face to face on a bit on bond, where we are going to look at the examination of the volatility of the market further, where we are going to look at the calculation or determination of durations on bond. There is also another way of managing and looking at the risks involved in bond, how bond really price changes with interest rates. And there is one measure that we call it duration. It involves a bit of calculation, even though I will really minimize the derivation of the formulas and other things, and look at some of the applications in there as in our course. But today we want to look at one aspect or segment of the market we call derivative market. The derivatives market. That is one of the important markets. Recently, we have heard of the challenges in the cocoa sector, where the price of cocoa, which is one of the major commodity in Ghana, supporting our economy, and at the individual level, supporting a lot of people to generate good income. We have seen that the international price of cocoa has fallen and Ghana is in trouble. The question is, could we have predicted this issue? And if we identify that we're to face this risk in the commodity markets, what could have been done in order to minimize the effects on Ghana, or pass on this risk to other parties in the international market? In the markets, on the financial market, we will look at the traditional or the fundamental instruments such as bond, shares. These are the main financial assets or instruments that are traded. Now, when investors invest in this market or in other markets like cocoa, gold, those that sell these products, the sellers and then the buyers, are exposed to uncertainty, that is risk. And so a special market or unique market are also created such that it will help both traders, that is the buyer and sellers, to be able to minimize their exposure. when it comes to risks. Individuals or companies, firms in the international market are exposed to exchange rate risk. How can we deal with such risk? There are uncertainties. It can fluctuate. When it comes to even the oil market, we know what is going on in the international market now with the development in Iran. It is anticipated that prices of oil will really increase, and that exposes businesses to some level of what price risk. And so this market of derivative is one of the market for minimizing the expected exposure of investors. We will look at what derivative market is or the instrument, but before that, there are certain things that we need to appreciate in the market. When we did the introduction, we're looking at the segment of the model. As part of the course, there are certain activities that we also have to appreciate to understand. We have the exchange market and have the over-the-counter market. Okay. In the market, we have a well-organized market or segment of the entire financial market where that permits exchanges of financial assets. An example can be the Ghana Stock Exchange. So normally call them the stock exchange. These are well organized with some structures and well regulated. Right. But in the market, we have the over-the-counter market where trading of financial assets can also go on. Outside the organized exchanges. Individual can buy shares of companies that are not traded on stock market. Companies can issue shares, bonds outside the stock exchange. Individuals can buy other company shares or trade directly without the involvement of the stock exchange. Such market is called the over-the-counter market. In the market, it is less regulated compared to the stock market, where companies and investors have to meet some stringent rules. The market is that over-the-counter market or the OTC market is very large. And I don't know, even among you, whether you have some investment in other companies, shares that are not even listed on Ghana Stock Exchange. It is possible that some of you or family members are having shares that are not traded on stock market. We have rural banks, we have companies that are doing that through certain dealers. Okay, so we need to appreciate that aspect of the market. And one of the things that we need to appreciate also is how trading is cleared. How trading is cleared. So in the market, we have even clearing houses. Okay, Doc, your voice is very low. Okay. Don't know what that is. Might be my. All right. Hello, can you hear me? I've got a message that I think my voice is very low. So in the trading, we have clearing houses in there. They ensure that each party, that is the buyer and seller, meet their obligations. In the market where exchanges go on, it has to be monitored because these are trading involve contracts. The buyer and the seller has obligations. Each partner has obligation, and parties can be exposed to their counterparties when that party defaults on its obligations. So in the markets also we have clearing houses, that operate to ensure that tradings are clear. And they are basically, trading involves at least 4 steps. We have a buyer and seller. Okay, that's might locate one another and agree on a price. That can be done through dealers. The connection, bringing together the buyer and seller, can be done through brokers. Okay. When the agreement, the buyer and the seller agree on the price, the trade must be cleared. Must be cleared. In the contract or in the process, the seller gets to know its obligations, when to deliver and where to deliver the asset, the mode of delivery. The buyer also receives some specifications on when to pay and in which account. And so it is one part of the market that we must understand. It's an activity that goes on, and they have clearing houses ensuring this. Now, when they all agreed, then the trading must be cleared. Okay, which involve the delivery of the financial asset for cash. And also the meeting of all other obligations, okay, over the period. Now, it can be a spot purchase. Even when it is a spot purchase, the clearing may take some few days, maybe 1 or 2 days before the assets and everything is transferred in the name of the buyer. So there's some process, maybe 1 day, 2 days may be involved. And this require the work of the clearinghouse in the market to ensure that all this activity goes on with where each market participant, or in this case, the buyer and sellers, investors, all of them meet their obligations. Once the asset is transferred into the buyer through the clearinghouse or the broker, and the clearinghouse also really basically involves the activities of the brokers. They will ensure that cash is paid to the seller of the asset, and all records are updated where the ownership records or that after the transfer, all the records regarding who now owns that particular financial asset, if there's share or bond, the name will then be registered or updated in this. So this goes on in the market. So basically, we have the exchange markets, as I said earlier on, and then we have the over-the-counter market. And in the market, as I said, there are a lot of clearing firms or clearing houses. Internationally, we have the Pershing, we have JP Morgan Clearing Corporation. These are firms, right? And they do this activity. They also combine the role of what? Brokerage, because they connect both the buyer and sellers and ensure that each seller as well as the buyer also have an open account with them so that there will be smooth transaction. Okay. So these are some of the activities, and we have firms operating in this market. Before trading, they ensure and facilitate the clearing and the settlement of the buyer and sellers. Actually, they interpose themselves between the buyer and what? The seller. They act as intermediary to ensure that there's a smooth trading activity. Okay, there's a smooth trading activity. They also contribute to the efficiency of the market. So we need to appreciate the role of clearinghouse in the market. Now, we also have to appreciate some activity that goes in the market. We have hedging, speculation, and what? Arbitrage. And as part of this study in financial, we need to understand this thing that goes on in the market. Okay. Can anybody differentiate between speculation and hedging? And so in the market, you have hedges, financial market, you have hedges, you have speculators, and arbitrageurs. What is the critical difference between these activities that go on in the market? Where if somebody is a hedger, if somebody is a speculator, somebody is arbitrageur, what's the critical difference? That's a question to the class. Yeah. Any critical difference between who is a speculator, who is a hedger, and arbitrageur? Or what's the critical difference between these three issues that goes on in the market? Yes. Let's share, let's discuss.
Hello, Doc.
Yes, please.
Okay, please, good evening.
Good evening.
Okay, so please, my idea. So with the speculation, investors speculate that prices will either increase or decrease. So, for example, if prices, let's say prices of a commodity will increase in the next few months, an investor will buy with the intention that when it increases, then he sells it to gain profit. Then with the hedging, investors use hedging tools to hedge against the risks of any loss. So they use hedging to protect themselves from any loss of any investment. And with the arbitrage, investors they buy from a different market and go and sell in a different market to gain more profit.
Okay.
Thank you.
Yeah. More voices. You want additional contribution? There's a mature class or any other view? Any other view? Oh, should I call names? Okay. Yeah. So there are three main activities. These three main activities also goes on in the market. Hedging. In the market have hedges. Really, hedging involves, it is a strategy to minimize an exposure. Okay, an exposure on an asset. Okay, an investor holds an asset, and in finance, investors are exposed to risk, not the uncertainties in the market. They are exposed to risks, price fluctuations based on fundamental changes. So, for a hedger holds an asset and then develop a strategy to minimize the exposure on the asset. Hedgers actually have the asset. They normally hold the asset. They show interest in holding the asset, either buying it or at certain time they have it and they want to sell. But they are exposed to price changes, which might affect the value of the asset. If you look at coming to our previous lectures on bond and on shares, you could see that price in the market is not stable. Okay, bond prices are exposed to what key market factor? What key market factor affects bond price? That's the question. I just want to go back to our previous lectures. What Dr. Bright took you through. What are some of the key factors, a major factor that influence the price of a bond or the value of a bond? Any? Hello? Hello?
Hello,
Hello,
Doc.
sir.
Yeah.
Yeah,
Doc,
Doc, I think the market interest rates.
Market interest rates exposes price of bonds. Okay, and so just a change of interest rate can affect the bond value. Say an increase in the market rate, okay, or increase in the expectation of the required returns on the use of bond, given that there is higher risk anticipated in the market. It can affect the price, the value of a bond negatively. Okay, so once investors invest either in the bond or share, they are exposed to market dynamisms, uncertainties in the market. The fundamental issues can affect the value of even an asset. So any investor is exposed to this. So for investors, they develop a strategy to hedge. And one of the ways is to buy derivatives instrument. We come to that. When they are exposed to a potential loss, then they make decision to hedge. So hedging actually is a risk management tool or strategy to minimize expected losses on an investment, or for holding some assets. So get this clear. There are certain things that differentiate them. For hedging, a hedger have the asset. Okay, a hedger has the asset, and then determine the risk exposure associated with it, and come out with a strategy to offset or minimize the exposure. Okay, so hedging then acts as what? Like an insurance policy in a way to reduce the impact of what? Adverse price movement. And one of the things that we have said, those that can affect, for instance, bond, some of this is the interest rate uncertainties. Okay. But when it comes to speculators do not actually express interest in really holding the asset for a long period. They do not. They are not investors, but they are market participants and players in the market that look for higher returns or profit based on expected changes or forecasts. So a speculator may not have the asset or do not particularly show a rare interest as an investor holding the asset for a long time. Investors actually tend to hold assets for a long time, right? But speculators are not actually rare investors. They play on or they take advantage on price changes with a certain expected changes, and then they make a decision either to buy the asset. So when they think that price of the asset is expected to increase, then they come to the market and buy with the intention that in future, when the price truly increase, they will make higher gains on it and quickly sell. So that is how they are. Okay. are market player, all right, which come to the market to buy asset, financial asset, with the anticipation of what? Selling it at a higher price. For a short period. Now, for the arbitrageurs, as one of you said, that is, they are also in the market, seen as market participants that take advantage of differences in prices. Okay? They take advantage of differences in what? Prices. So they will be spotting for difference in prices. The speculators really, based on their decision to buy as a, based on future or price change. But the arbitrageurs come to the market when they, or that participate in the market when they identify that price what in the market differs. And for that matter, at a certain time that they estimate and identify that the intrinsic value, okay, is different from the market value of the asset. And when they believe there is a mispricing of the asset in the market, then they quickly what? Make either buying or selling decisions. So for them, arbitrageurs take advantage of prices. Now, if I'm to take you out of the financial market and come to, say, the ordinary market that we do, you know, when you get into one segment of the market in Accra, for instance, if it's those that are, for instance, in the Abosu account selling engines or whatever. Now, the price of engine, though they are all in the same market, the price of engine of the same car might be different from one shop to the other. Okay. So when there's an arbitrageur in the market, he will be looking at the difference in the market from the different shops. Now, where he believes that the price, okay, at one shop is relatively too low, then he can quickly go and buy there and go and negotiate and quickly sell it at the place where he thinks that he can get it higher. Okay, so they really look for price differences in the market and make decisions to buy or to sell an asset. So that is what arbitrageurs are. Okay, so one of the important market that helps hedging is the derivative market. In the derivative market, we have some financial instruments, we call them options, futures, and forward. Okay. So we need to identify this, and this one will take us into what we call the derivative market. We are going to specifically look at some of the instruments there. Okay. So for a hedger who wish to, for instance, offset its exposure, they can either take a long or a short position in attempt to hedge a risk. An investor can take a long position, that is, with the anticipation in the market, buy an asset, make the decision to buy an asset before the price would increase. That is taking a long position. Okay, so when an investor, for instance, holds a bond or a share, now the investor can make an attempt to negotiate and sell the asset to somebody before the price drops. So having an asset, a financial asset, where you negotiate to sell the assets to some other interested investor is called the taking out, a short position. And when the decision is to buy before a price increase, then you say that you are taking a long what position. So as, for instance, an investor who really needs a particular item, for instance, like you may be even in the market of, say, let's take, for instance, a firm that is into production of Milo. Milo, right, is into production of Milo, for example. Now that the price of Milo, the price of cocoa is down. Now, if the firm analyze the market in the cocoa market and get a reliable belief based on certain rational analysis, okay? Rational analysis. There's a theory called rational expectation in this. We expect that in such circumstances, investors make every effort to get fundamental information about the asset that they need and predict the market. That's how investors do in order to hedge, okay, and look at its long-term effect. So in this, the firm that thinks that they may it might need cocoa in order to manufacture, say, Milo. If the firm anticipates by every information in the market they have gathered, they anticipate that price will likely increase. Okay, so they will then negotiate with cocoa producers or suppliers beforehand to buy and fix a price. In that case, you say that the firm is taking a long position. The buyer is taking a long position because he fears that he really needs that item or the cocoa for production. Speculator doesn't need the cocoa. I'm still trying to. A speculator may not need the cocoa. All that is believed that cocoa price will come in the market. For instance, let me say the same thing. When somebody is a speculator, they may think that every year, and I believe that right now what has happened, a lot of them are suffering. They think that every year cocoa price is guaranteed. At least it will go up for every year. I mean, people are saying that in the history, this is the first time of having in Ghana here a cut in cocoa price. So there are certain individuals in the market that because they are speculators, they are going to lose hugely than the actual cocoa farmers. You know that people vote money or they get some money to buy and store, thinking that every year government will increase price. So they devote some money and buy it. These are no cocoa, farmers, but they take advantage of the direction of the cocoa every year and buy and stock it. And when there's a new price, they quickly sell it and make profit. That is how speculators do. They do not. They are not producers. They don't have any rare exposure, true exposure in the market. cocoa farmers are exposed to risk. And for the first time, they have realized that the market is risky. There are uncertainties. So a farmer in future will want to hedge and can go and negotiate with some of the buyers and fix a price. So negotiating with some of these buyers ahead to sell, it means that the cocoa farmer is taking a short position. That is one terminology that we need to appreciate. So cocoa farmers face rare risk. Speculator, the person who wants to buy and just keep it to benefit from high price in the future, doesn't have any exposure. So that is the difference between hedgers and speculator. When we talk, we are differently hedging. Yes. Yes.
Yeah, hello, sir. Good evening.
Yeah.
It's possible that speculators also force artificial shorting.
Who?
Speculators.
They can also what?
Create artificial shorting so that for price to increase for their own benefit.
Can they create
so, artificial shorting?
Mm-hmm. Okay.
How do they?
How?
So
Mm-hmm.
From your convention, I mean, you were saying that they can just buy and hold. So that when prices go high, then they sell gain profit. I'm also asking, what about for them also buy and hold so that they'll create some shortages in the system so that price will just shoot up? I'm just asking whether it's possible like that.
Okay. So yeah, so fine. The effects of their activities can create speculate can create some of these shortages, especially in the currency market. It happened like that. Speculator can cause exchange rate really to change. Okay. For instance, in the exchange market, the individual, if they are speculators, they are not exposed in any way to exchange rate. They are not into business that require that they have to buy, say, currency, dollar. Right? They are not doing any international business. They are not, say, not expected to travel. So the activities that they are engaging now, they may not really need dollar or pound or foreign currency for anything, but their business is just to, like I'm saying, come into the market, and then they make speculation. Oh, for instance, coming to Christmas, they anticipate that the cedi might depreciate. Okay, seasonality, they come based on that. And if you look here in Ghana, that is what normally happens. So some of them will start buying the foreign currency, keeping it, and then when the cedi depreciates, they sell to make profits. Yes, they are doing their own business, but they are speculators. And speculators can cause artificial shortages in the market like that because of their activities. It can cause that effect. Okay? But in fact, when we are dealing with it, their intention is not to cause that shortage. Their intention is to benefit from future increases. So they buy, stock it, and benefit from huge profits in the future. That is their intention. The artificial shortage might come as what? Some latent or a secondary issued following the activities. Okay. Good. So with this example of cocoa, and I believe that we have really appreciate the difference between who is a hedger and who is a speculator in the market. Okay. Who is a hedger? Who is a speculator in the market?
Hello, Doc.
Yes, please.
So, per what you said,
Yeah.
when it comes to Ghana's, let's say, forest market, uh, do we term the activities of speculators as criminal? Because when you look at 2023, thereabout, when Ghana's economy was going through turmoil, the Bank of Ghana undertook some exercise by arresting speculators and, let's say, those in the Abuchi market who handle, let's say, forests. Most of them were arrested and, let's say, their cash were seized because, say, their activities were inherent to the volatility in, let's say, the dollar to CD exchange rate.
So the question is that, are they?
Yeah, do we term their activities as criminal? Speculators.
These are legal matters. When we talk about criminality, then it comes into legal matter. Now, one of the issues in the financial market is that, especially when we talk about the over-the-counter market, it is also regulated. It's also regulated, like those things, guys that call them abuchi and all those things. They are also regulated in a way, okay? And in Ghana, we should to trade, to buy and sell foreign currency, you might have to register as an institution. That's why we call it these foreign exchange firms. Those were arrested because they were on lances. If you're on lances, then fine, you fall into that criminal thing that we want to say. If you are dealing with currency, money issues in attempt to profit from it, right? Buying and selling without a license, you are committing a crime. That one I can say for sure. To do anything like dealership activities in the financial market, buying and then selling in this, you have to get a license. Now, individual like me and you, also we are regulated in a way as to how we should really buy currency. Yes, the system knows that you may need a currency, foreign currency to travel. You may need foreign currency for one or two reasons. And that you conduct your activity in the former, what do you call it? Market, that the banking sector and other foreign businesses that have been, or firms that have been licensed. If you are not licensed and then when the economy or the market is facing some turbulence, that is where they come at those guys. That at the time that they cannot control, for instance, if the market or the currency is depreciating so highly, that is where they come and look for the loopholes and then arrest these guys, right? But those that are licensed can still operate. You can't arrest them. Just that they are also given some requirements to meet on a particular day, how much they can even transfer, how much they can even, and if you even as an individual, you are restricted or there's some limit is placed on the amount that you can even transfer. Okay, if there is a breach, even as an individual, together with the bank can also be sanctioned. So even a bank that is even license can also breach the rules, and sometimes they are sanctioned by the central bank, and they can also this thing can also be termed as even let me say, can I say criminal? I don't want to because they also breach the rule, and they can also be punished similarly as those that are outside. Yes, those who do not have lands, we can say that the activities are criminal, and therefore at any point in time, not only when this thing currency is facing some turbulence or this thing, that's where we arrest them. Because every market is regulated, and they come at certain regulators, especially in the financial sector. When it comes to the money market, it's regulated by the central bank, and they come out with a rule in order to minimize these uncertainties in the market. But I mean, these days with the technology, you know that individuals are open even foreign accounts online. Digitization of the market is also making things very difficult for regulators to regulate transfer of money in the system, right? Everything is now becoming digital, and that these days a lot of people are trading even currency outside the banking system. People can open this thing online, buy online accounts, and trade with some of these clearing houses internationally. It's going on, and I'm doing some small business, and I wanted, for instance, I wanted to do everything at the banking sector, transfer. But if you go there, and as a small business that I've started, the requirement, I went back to, what do you call the Abochi people, so that I can have my peace. I wanted to ensure that, with my level and understanding in the market, everything, formalize everything. But those who want to formalize everything and do their business in the banking sector, let me tell you, there are a lot of challenges that you can also people, and I got to know how can these people, Abochi people, can sell or buy this and transfer it from outside. It is going on there. And the market people, as those who are doing some international business within Africa, they prefer doing the business with Abochi people than at the banking sector. Because you go there, the rules that have been set. So that I was advising on these bankers. Can you tell your this thing and meet with Bank of Ghana, right? And the banker have to, so that they can minimize even the rules and the strict this thing that small business have to meet in importing things from outside. Now, because of the stringent regulation, this market women doing business in Africa, they are doing, they dislike even going to the bank. And one place that I know, if you go to see the volume of money that they transfer from, they say, ask, how is it possible? But these people have created what is called peer-to-peer system outside the banking sector, right? Outside the banking sector. Now, they may have a partner, maybe in Kenya, right? And they will transfer, if somebody wants to do a business, maybe in Kenya, buy something from Kenya. You go to see these people, they will get your money, charge you with a rate, and then they will transfer the money. How do they transfer it? Their counterpart there will transfer the money, that is their counterpart in Kenya, will transfer the money into your business supplier somewhere in Kenya. And then if somebody also is in Kenya that wants goods in Ghana, they also contact their their counterpart here, and their counterpart will transfer money in local currency and buy the thing on behalf of them. And the other day they net off. It's what's called net off. What how to balance. So they pass through the banking system, outside the banking system, and they are doing their business. And in that case, controlling exchange rates become very become very difficult in the current situation that we have. And even with the coming with the cashless system and the development of distributed ledger, that is where there's an attempt to even eliminate the control of central banks and banks in the system. That's the future of finance. If you look at digitization, it will come to a point that, I mean, people will do business peer-to-peer. You transfer money from your account straight away without banks. And it's going to happen in the future. That's why these Bitcoins or the digital currencies are coming. In future, when they succeed, the cash system or the fiat money system will become useless and nobody will use your destiny. So it will be very difficult to control them. Yes, a message has come. Let me see. Okay. Is anybody in the working the bank in our class a banker? Do we have a banker in the class?
Yes, please.
Is it Bismarck?
Yes, please.
Yeah, Bismarck.
Sir,
which bank are you?
I'm in a rural bank.
Okay, then the rural bank, you do not deal with exchange this thing.
Yes.
Yeah, we are limited. Your rule is limited in that. So the law
doesn't permit that.
Yeah, doesn't permit you to operate. I wanted to ask some questions. Those who are the commercial banks. So let's move on.
Hello, sir. Hello, sir.
Yes, Sam.
Please, I have a question.
Okay.
From the discussion we just had, you mentioned that hedging is a risk management strategy.
Yeah.
My question is, under what circumstance would hedging destroy the shareholders' value?
Okay. That's a question that is on the board now. All of us are supposed to. It says that under what circumstance can hedge destroy or weaken shareholders' value? Under what circumstance? Now, let me come in because this is a technical thing. Hedging, as we have defined it, is a financial engineering mechanism. Okay, financial engineering mechanism to minimize expected losses on an investment or shareholders. So we expect that risk managers should have enough knowledge in the hedging process and what to hedge. And what to hedge. It is not meant for speculation. Shareholders can lose value when risk managers speculate. Have you heard the name of one Ghanaian financial guru, Kwaku Adiboli? Or if I'm getting the name right. Am I getting the name Sam?
Sir.
Have you heard?
Please,
Yes, please. I heard that story, sir.
What is the story? Can you?
I think he entered into speculation also, and he caused a financial loss to one, I think, bank outside also, and he was
HFC. I think HFC UK, one of the prominent, and this guy, I mean, is an expert. Let me put in that expert in a financial who was also managing that top bank treasury. Okay, it is a nice case. Maybe I'll have to find this thing and caption that thing and then use it for a case study. situation where shareholders, a bank or an institution can lose. But this guy, I think he's run even in Ghana. I think he was in prison later in UK and he was released. He come to Ghana and he's doing well in Ghana. I like the guy. Okay. But he's an expert in risk management and the bank has hired him in UK. You can go. I just forget some of the facts. And they are managing treasury. And the treasury of the bank, you make decisions to hedge. Okay. But I mean, they were doing but if you look at the story, the story is right. Okay, we were doing things but not following the procedures of the hedging. You have a limit even as to the amount at any point in time to budge, right, or sell when it comes to currency and all those things. But here the case that there are certain times that you may speculate even as a manager, a risk manager, because there's a thin line between speculation and hedging. For hedging, you must be able to identify the rare exposure, okay, and make decision together with, when you look at risk management, their board even concerns, some of them have to go to the board and make decision. And some of the losses, you can even leave it. That's why I was trying to use the essence is to minimize, if you are hedging, is to not make profits. It is not, you don't go into hedging to make profits. It is to minimize, that's why I call risk management. It is to minimize the exposure, the risk that the firm is currently or in future is expected to meet, right? So if you look at the exposure, you calculate the exposure, you determine and forecast it, okay? Before you enter into the contract with the counterparty. So there, you first of all, as I said, determine the rare exposure, okay? You have the currency, you have the assets, you have the car, but you fear that the car that you are selling, I mean, it will devalue in future. So you make, and even with your valuation in finance, there's a process of valuation, factors that you have together and arrive at, and that's where comes in what is called the rational determination of prices. You know, Dr. Brian have taken you through the determination of bonds and all those things. These are intrinsic. These are theoretical. So you gather information. It's not just by saying that the price of bond is equal to that, and no. These are also impacted by inflation, exchange rates, other things that you should be able to forecast and know the expected trend. Okay? And it comes with statistics. Okay? Forecasting the time series and all those things, and getting the issues right. In Ghana here, I think the prophets are even become now forecasters. They gather information, what is Trump is likely going to do to Iran, and some they say they forecasted that, they prophesied that Ayatollah would die. I believe that some of them, they also follow the news. Okay, and they are looking at the trend and all those things. These are things that is happening. So for financial aspect, I mean, we require data analysis and all those. If you don't do that, and you just do everything and you are misinformed, then you can cause your company to lose. Even in attempt to hedge, you turn into speculation, and in that case, you lose more. Are you getting me?
Yes, sir.
Yeah. So when the risk is not well calculated and the amount of exposure is not known, but the risk manager makes an attempt to hedge, it turns to speculation. and price can either change unfavorably. And that is where so if you like, you read the Kwaku Adibolo issue and you appreciate some of these things. In that case, they really the bank was exposed. And when the bank is exposed in that speculation, he was even doing this beyond his limits. I mean, if you are treasurer for this thing, you do trading on behalf of this thing, but you are given a limit. If I remember one of the story, in one of the this thing that he did, I think it benefited the bank. He really brought in huge this thing. But at that time, he had gone beyond his limit without informing his superiors. And he got into the head, and then he attempted to do the next one. And then there was a fall, huge fall. Okay, so hedging is just like, what do you call it? Speculation is just like the lottery thing that people do. But hedging is not like that. Just get your exposure, what you are exposed to. Make an attempt. If you are not able to even eradicate it. Normally in finance, in risk management, we don't say we are eradicating or reducing risk to zero. You make attempt to minimize it. So I normally prefer using the word minimize it, the losses. So the loss can be 100,000. You look at the extreme value, maybe the extreme value is 100,000. Okay, that is what we call the value at risk. You determine, there's a process of determining all those things. You simulate it and see all the possible, giving all the information, simulate it and determine the value at risk. Okay, you are exposed to a maximum of $200 million give on the business that you are doing. So how can you? So you find a way of at least passing on some of the expected loss to other counterparty by taking an opposite side of it. And you must be sure that the decision you're taking, if you expect price increases, then all things being equal, the price will increase. And therefore, when you take a long position to buy an asset before you are right in this situation. Okay. So we have talked about the speculation, and they are basically there's pros and cons of it. Okay. If you are doing that, the speculator may get higher returns just for a short period. And I've stated that they are not intended to hold this thing for long term. They want to benefit from price changes. Okay. They positively contribute to liquidity in the market. Okay. They contribute because their activities also help buying and selling. Okay. They are, when it comes to exchange market, sometimes they can release some of the dollar into the market when they see that the CD is expected to appreciate. Some of them can just see the Abochi guys and sell them. They contribute to liquidity. The activity every day in the market also help in liquidity in the market. They contribute to price discovery. Okay, price discovery. They help in this direction because the activity in the market, in the market, in any market, when there's demand, high demand and supply, the economists will tell you that temporarily there will be some distortions in the market, but definitely the distortions that they create in the long term, the actual price will then be discovered. Okay. And one of the disadvantages is that, I mean, it is a high risk. And then when they are losing, they lose more, hugely, because their destiny is one-sided. Okay. They can contribute to volatility, as you said earlier on, and bubbles can lead to market crashes. Okay. There are some irrational behavior and herd mentality. Now, normally, and behavioral issues comes in. When they see, they do not base on their decisions basically on the fundamental or the intrinsic value of the asset that they have determined based on information. They heard. What is heading in this case? Heading is where they see that, oh, everybody see friends and other, so they follow the crowd. They follow what others are saying, just make decision, buy or sell. And that causes a lot of losses to them. Okay, we expect investors, true investors are rational. So they collect fundamental information about the asset before they make decision to sell or to buy. But where they had behavior setting, it's just to follow the masses or to follow the crowd. Just join the bandwagon and dance. Okay. And that is what they do. They just join the bandwagon and make decision. Price is expected to increase without any fundamental information, right? Without any, so they see that people are buying more dollars, then they get also influenced by this decision by friends and other. It is the same thing that happened in the men's gold issue in Ghana some time ago. And it got to a point that when fundamentally we were asking questions and advising, I got some of them were professors that I was advising them. They will not, when heading setting, we become irrational. He become irrational. And just like the young girl or the young lady that have find a nice boy, the parent cannot stop. Whatever the reasons that the parent will want to give. No. Right? So when heading comes in, it becomes very difficult for people to even follow the analysis. And in the case of men, when they started, I said, this is not fundamental, this thing. I advised them. Some of them, later on, they came and said, Nsiah, what you were saying is true. They lost heavily. Now, how can in Ghana here, somebody set a bank and say that, for instance, there was some of the banners were set up, and every month they promised 50% returns. Fundamentally, 50% returns every month. Oh, how? How is it possible? There's one guy that is here with, I mean, some of you are doing your rare business, a true business, isn't it? You are in the commodity. How can you generate 50% every month? Or some of even went to the extent of paying 100% every month. There's no fundamental support for this historically, right? And no business, I mean, can, for a long term, in the short term, some of these things may happen. Short term, that's what speculators do. Short term, yeah, they can benefit. But in the long term, you lose. Long term, when you have to do it for quite a longer term, you see that you come to it's a zero game. So we have talked about the arbitrage and so forth. Now let's go to the main this thing. These were just two because we may need some of this thing in the next lectures. We want to look at derivatives. Okay, derivative. What is derivative, and what are some of the derivative instruments that we can help businesses to hedge or individual to hedge? So look at forward options and that. What we should be able to differentiate between futures, forward, and option market or instrument or contract, what we may call it. Okay. And so we should also be able to know the important features, okay, in such contracts. The determination of the intrinsic or the theoretical price of futures contract, we'll go into it if time permits. So what is a derivative? What is a derivative? And it is defined as a financial instrument which has its value. Its value is determined or is derived by another asset. It is a financial asset or an instrument. But its own value, its price, its value in finance and the value and price are interchangeable. Its value is determined by another asset. We call the asset as an underlying asset. Okay, an underlying asset. It derives its value. That's what I call derivative. That financial asset derives its value from another asset. So it is dependent on other assets to know its value. So we may have derivatives that's its value or its price is determined by, say, a bond. And the bond will be the underlying asset. It will be determined by a share. So a derivative can be written on a share, can be written on a bond. We can have derivatives because we are dealing with financial market. I don't want to go into commodities. There are derivatives on commodities: maize, oil, cocoa, millet, and so forth and so forth. Okay, even in the market. So there are derivative markets there in separate this thing. But because we are dealing with financial, this I will look at the main derivative instruments on bonds and shares. Okay. So we have different types of derivatives. Basically, we have 3 of them or 4. That's what's coming of swaps and all those. Even disease, the other, we have swaps, options, and the rest. But let's look at the fundamental ones. We have the futures, we have the forwards, options, and what? Swaps. Okay, futures. It is not future. It's S, it's a next and now. Special noun or special name in the market. Futures. We have forwards, swaps, and what? Options. Okay. And I said we may have the underlying assets. That's a particular derivative instrument. Derived value can be a stock, it can be the bond, it can be the currency, okay, commodities, and another thing. Even we have a derivative on electricity price in the developed market. Derivative in the developed market. Okay. Apart from that, even in the ordinary shares and bond contracts that invested get into, some of them are embedded even with derivatives already, options. Okay. Even when you go to business side, companies, employees sometimes are given option contracts. If you get this target, if you're able to hit this target, you're able to get this value. Special managers or some employees, some of the contracts that are written and they are having their bonuses and what the benefits are derivatives, because we are able to meet what you earn at the end of the set, maybe a particular year or term or quarter, depends on certain performance that you put up. Actually, you are holding a derivative instrument contract. Okay. So a company may even issue a share. It happened, or employ somebody. And as part of the contract, you can begin an option that when you manage a company or managers manage and the value of the company increases, you can even buy or you'll be given a share. It is an option that you can exercise. A bond, some company can issue a bond to investors. Investor may buy the bond, which is a supply of debt. They may not initially want to supply funds to the company by being shareholders. But as part of the negotiation or the contract that will be written, they can write what is convertible bonds in there. That at a particular time, given the value of the share of a company, they may have the right, let me put it that way, they may have the right to convert the bond to become shareholders. It is an option. It happens we call them convertible bonds. Okay. First, the supplier of the bond, of the money. Okay, in this case, the buyer of bonds. That's what I mean. You go out and buy, you are supplying money. You are crediting money to the company in a way. So in the bond contract, okay, there could be a convertible option where maybe they can say that in the next 2 years, after the price of the shares is like that, you can convert all bonds and in equivalent get shares in the form of shares. So you convert the bonds to, but it become an option for the investor to exercise. Okay. So we have a lot in daily activities or businesses that happens, or even in life. If you do this, then you fulfill this is what you be given. Okay. It is that have been upgraded and coming to the former financial market. Now, this historically have been there. In the olden days, a farmer may need, may anticipate that the price of whatever this thing that they do, the farming product will fall. They can negotiate ahead with buyers and fix the price even 1 year ahead. When the products or the fruits mature, then they will sell it to the buyer based on already agreed price or price that was agreed initially. So it has been there, just that it has been formalized into even formal currencies, CBOE, exchanges even in US. We have maize, we have gold, we have a lot on there, okay, that these were derived or was taken from normally some of this agreement that individual used to have with people, and then it was formalized. So all these things that you're talking about, options and all that, it is what? Guided by contract. They are basically contract. Okay. They are very basically contract. So they are agreement between buyer and seller. Okay. So agreement can happen between a buyer and a seller where one will agree to say pay $100. Okay. If a security price is greater than what? Say $300. So this is some agreement. Okay. There is some agreement. So these are, once there's an agreement, it means there's what? A contract. And we have exchanges where formal market or exchanges where derivatives instruments are traded. And then international market, we can pick a major one at CBOE, Chicago Board Option Exchange. Okay, you can. This is like a stock exchange where derivative instruments are traded. You can get futures for 1 month, 2 month, 3 month, quarterly, and all those that you prefer, and then you buy. But they have specific days, months of which they mature. So you have May, March, you have June, some going September, August. These are traded there. So there's a particular formal exchange where when are taking some of this thing, because some of this market are not here, we all become a bit of there's over-the-counter market there, where, for instance, you may need $1 to travel in the next 3 months. You can get into the bank and negotiate ahead with the bank that you want to buy $1 at, say, 12 cedis the next 3 months time. When the time is due, that is how much you succeed in really having that contract from a bank. Then it is also an option. Sorry, it is also a derivative. If you are able to succeed in that, you may need $10,000. You think that maybe in the next 2 months, in 2 months' time, you think that whatever is happening there may be based on your forecast. I'm saying that because you are supposed to hedge, you are not supposed to speculate. You will need funds to travel or to buy something. So you anticipate that maybe the cedi will depreciate against maybe $1. You anticipate that the price may go even 14, given what the information that we have and the analysis that rationally have done. You think that the cedi will depreciate, okay, further, and you anticipate maybe a range of which it will happen. What do? You can go to foreign exchange or go to a bank, which is part of the over-the-counter market or a butchery market, as we call it anywhere, and you sit down and agree the price, maybe 12 cedis per $1. So agreement to be today, and the price is fixed. Now, in 2 months' time, when the date is due, you go and pay at the $12 price. That's all. Even when it has gone to $15, it is that is an agreement that you have. Okay.
Hello, sir.
Agreement. Yes.
In practice, does it work? Because I realize that, let's say my company, the bank would rather advise you to have an expo account, buy the dollar or the euro, put it there when you need it. Then you can just fall on it and use it to do your transactions.
You see, that is in practice here in Ghana. These are difficult when you're teaching some of these things. Okay, in Ghana here. But in practice in the developed market, that's what their market is. Say their market develop. They know the risk and they appreciate the risk. Okay, so they practice there. In Africa here in Ghana here, that's when I was saying that my business that I was doing, it got to a point that my wife got angry with me. You want to bring academic things here. I get in it. You go to the market, it will not. I mean, the guys there in the market that are supposed to know, they do not even appreciate it. That is why some of you are also here, and we expect that this will be encouraged in the market because it is practiced out there. Some of them, maybe in Africa, we have even a whole essay. That's what I'm talking about. It's an essay for it there. It is displayed. If you want 3 months, you want 1 month, 2 months, those are maturing the next day. You can enter into that. And that is where they hedge their risk. But if you are advised to go and buy huge amount of dollar, open an escrow account, you buy the dollar and put it there. It is possible that you'll be exposed hugely. Because that means that you have to buy it today at the spot. But the contract, you don't pay anything at the spot. You don't pay. It is a contract that you go and negotiate. So become a paper. It is not a contract. And they're even written options in there. That's why we have the options. When you have that contract and you think that maybe you agree, for instance, if you have option on and on $1, and you negotiate an option with the bank on $1, and then on the day, maybe you think that 3 months time you negotiate and agreed on, say, $12, but in when the month mature, that the 3 months matures, the market price of dollar is, say, 10 cedis. 10 cedis. If you have an option, all that you do is that you don't exercise it and go and pay the $12. Rather, you pay the spot market that is 10 cedis in that has occurred in the month that the 3 month ending. Are you getting me?
Yes.
Yes. So for the bank even to agree that you pay a bit of what is called a premium for the bank to give you that right, that the 12 cedis that we agree, in maybe we are in March now, in June, when it matures, the 12 cedis that mature, we are giving you the right, we call the option, to exercise it. But you pay some fee, we call the premium. We come to that once we move on. So that when the price is not in favor of you in June, you are not obliged to buy the dollar at $12. What you lose there is only the premium that you have paid to the bank, small amount, and then go and buy the dollar at the spot. That is being practiced in the international market. But in Ghana, I know it's going to be difficult because they are not bringing the international best practice there here, and we don't have strong derivative market here. But I believe that the market, so if you go to the Makala, so the farmers are doing their own derivative activities somewhere. Because I know in those days when people want to really farmers are doing their farming, maize and all those things. I know some people who go already and go and tell them that I need this bags of this thing. Let's agree. I need about 100 bags of ginger or maize for this thing. Let's fix the price. When this thing come, we are product materials. I'll buy it, and they do this outside it. But in Ghana financial market, I mean, practicing this, it become difficult because I don't know. But with education, as we are learning, we may move on and be able to fulfill that. Yes. Yes. Hello. Hello. I think somebody wanted to contribute. Can I move on?
Yes, sir.
Yes, sir.
So we expect that the more we become financially educated, that is where we believe that some of you may go to even central banks. Some of you work in banks. And as people become financially listening, and those who have the opportunity to work in some of this market, we should be able to implement it. And both, it is not one-sided. The banks benefits and also the traders will benefit. Those clients also benefit. Two sides. So what are some of the uses of derivatives? One, for risk management. Okay, risk management. In fact, the main purpose is to hedge our risk. Okay, to reduce risks or to reduce exposure. Some also use for just speculations. And here it is very dangerous. Okay, for using derivative to speculate. And that is why a lot of losses happening. One, because derivative, if you are using derivative to hedge, we expect you to have at least been exposed to the underlying asset. If it's a bond, the investor should have a bond and maybe make a decision to say hedge on it. For instance, if you possess an asset like a bond today, you only hedge a position when you think that the price in future will fall. So you negotiate with somebody, right, to fix the price or agreed on a certain price. Now, when the price indeed fall, you benefit. Now, when it goes up, the price, your forecast, you get your forecast, this thing wrong, and the price goes up. You will lose you make some losses there. You make some losses there on the agreement. However, you have the actual assets. So you can pay off the difference, but sell the actual assets and to minimize your losses. But speculators do not have any assets. They just enter into a contract. The only contract that they are into, they do not have any rare or the underlying assets. They just enter in the contract. Now, when they are losing, they cannot also have access to the actual asset to sell to offset a portion of their losses. So speculation is very dangerous in the derivative market. You have to be very careful. Okay. It also helps in the reduction of transaction costs. Okay. Transaction costs. When you are able to fix your position, okay, or swaps, another thing in future, you are able to, the cost that for instance, that you may incur. Then you also have regulatory arbitrage. Financial markets are highly regulated everywhere. Okay. But market participants will want to circumvent. Okay. Regulation. They don't want to be regulated or circumvent some of the rules. And they can use derivative instruments, which is less, even though regulated, they can just use derivative in markets to circumvent certain rules in the market. It is what example is what Men's Good wanted to do. Okay, he created a financial instrument, and they called it I don't know. They have this thing. Say they were dealing with only gold in there, and so they created something out of it's an instrument that they created. Now, when you ask them, say that Bank of Ghana, they are not dealing with buy and sell of money, so Bank of Ghana cannot regulate them. Two, Securities and Exchange Commission cannot also regulate them because they are not dealing with stock and bonds. So that has been and was the argument then. I don't know whether in court they are still making that position. But Bank of Ghana said, what you're dealing with money you are taking people's money to buy gold for them, if indeed that was happening. Once it is about buying money and all those things, you are under our ambit. Later on, Securities and Exchange Commission also came in. So the other people developed some of these derivatives just to circumvent existing rules. It is possible. It is possible. So it can also be used to really minimize our future liability. Okay, minimize that, especially in the swap interest rate can be swapped in the swap market. When you get there, or get opportunity to study further. Some firms can swap even short-term for long-term, and also variable interest rate for fixed rates. Okay, and it is a way to change the liability. A company may have entered into a loan which its interest rate is, say, floating. Another company may also have contracted a loan which interest rate is fixed. Now, the derivative market can permit the swap of interest rates between two. So one will pay the floating, the other will pay this thing. These are all based on the forecast of individuals. So they may swap. It get to a point that individual in the market may want floating. For instance, I have gone for a loan that its rate is floating. When you say interest rate floating, what does that mean? It means that when market rate changes, it also affects it. Okay. Another business has gone or person has gone for a loan with a bank that also its interest rate is fixed for long term. And they later on, based on the market change dynamics, they may think that fixed interest rate is not good. They rather want floating. Said that, especially when they anticipate that inflation will be reducing, and therefore interest rate will likely fall. They want to get counterparties that also have different view, and they are looking for, say, floating interest rate. All of them has its own benefit. But when it comes into this, they can meet and they can swap the interest rate. And in a way, it can minimize the cost that one really firm is expected to bear. Okay. So who are the users or the end users in this market? We have corporations. Okay. Corporations. Investment managers. Those are managing investment, bonds and shares, mutual fund, and other things, this thing for on behalf of their clients. They are the ones that also engage in derivative activities. We have individual investors are also beneficiary of the derivative market. Now we have market intermediaries, okay, like banks, financial intermediaries like banks, brokers, okay. They also are part of the system that the derivative, they are market participants, let me put it that way. We have central banks who also are regulators in the market. They also are have keen interest in this market. Okay. So now we come to one of the main instrument. We call it the forward. One of the main forward derivative instruments. One of the main derivative instrument forward. So there's an instrument, we call it forward. And what is that? It is an agreement. See, earlier when I said that all of these things are agreement, which are contracts that really oblige parties to meet the contractual terms. Okay. So a forward is an agreement, okay, for the future delivery of an underlying asset by a seller. Is an agreement. Okay. An agreement. For the future delivery of an underlying asset by the seller. The seller will have to deliver the asset at a specified price, agreed price, also called a strike price, depending on the text that book that you mean. So there's a time that the agreement will expire. So we have what is called the expiration date. Okay. We have the expiration date. We have the strike price. Okay. The strike price or the agreed price, which is pre-specified or stated in the agreement. There is a time that it should expire. Okay. When the agreement is written, there's expiration date. All these things have to be part of the agreement, because the agreement and or the forward agreement cannot really go on forever. It can be 3 months, 1 month, 2 days, 5 days, or depending on, normally forward, these are occurs over the counter. So it's the agreement between the parties that are involved. You design the agreement. Okay. So the important features of a contract in this nature is that the delivery of the assets wouldn't occur at the spot. It will occur at a later date, which is also agreed and a certain price. Now, when the delivery occurs, it is when that price will also be paid by the buyer. It will be settled by the buyer. So the settlement of the asset occurs at a later time, but the agreement can occur today, which is written today. And this agreement, each party will hold them, or it can even be led by a broker or a clearinghouse. They also do that work. So this will be negotiated. The parties would have their instrument in their bosom, or they will hold it. The instrument, this is the agreement. But it's one party with the seller that have also the underlying asset, who thinks that he will be exposed in the future. Okay. And once he'll be exposed in the future, he writes the agreement and look for somebody who will buy the agreement. He will write to sell. But the transaction or the transfer of ownership of the asset wouldn't occur today. So somebody can have a forward agreement on shares or bond maybe for 2 years, 3 years. The transfer of the shares will not be in place or will not be exercised on the same day that they agree on the contract. The seller or the holder will enjoy the dividend, everything as a shareholder. By a certain date, if it's 2 years, the transfer will occur. And it will be transferred or sold to the buyer. And the buyer will pay the agreed price. The agreed price. There are certain rare issues that can happen. The price that has been agreed can be on the period where the expiration occur, the spot price will be different. It could be different from what was agreed. Assuming that it will mature at the end of December. At the end of December, the spot price, how one can buy really the bond or the share, the price will be different from what has been agreed. And what will agree maybe in March between the buyer and the seller. So when the price goes up, okay, the price goes up, the buyer gains. The buyer of the contract, you gain because you are saying fix a price or agreeing a price, say 10 cedis. Specified price 10 cedis per share. 10 cedis per share. Okay. Now, this payment will be done, maybe you agree on, say, December 2026. Okay. At the 12 months, December. But you meet today, March, you agree on $100. Now, when December is due or at expiration time, now 3 things are possible. 3. The price in December of the underlying asset could be, say, 15 cedis. It could drop also and come to, say, 9 cedis. It could be the same thing as 12 cedis. So these 3 scenarios are possible. 12 cedis, price being higher, and then also that. Now, when the price is higher, the buyer, the one who took the long position, the buyer of the contract gains because already has agreed this. He can then pay the 12 cedis per share and sell it on the same day in December at 15 cedis, and he gets a 3 cedi profit. It could also be that the price will be the same thing at 12 in December as was agreed today. So no gain. Okay, no gain. No gain. Now, it could be 9 cedis. In this case, when it comes to 9 cedis, the seller of that contract gains. The seller of the holder of the asset will gain. Now, in December, assuming that the price had dropped to 9 cedis, but they had agreed with at the price of 12 cedis, he gets a gain of how much? How much will be the gain? That's also 3 cedis to the seller. The seller gets 3 cedis gain. Okay. So that is where, in this case, hedging may come in when the seller anticipates that price may fall to 9 cedis maybe in December, based on information. Okay. Then the buyer of the contract, the one who is also want to take a long position, also anticipate that the price of it may be higher than, say, 9 cedis. So they meet and then they negotiate with the price. But the spot price will be, so the future spot price will be different from what is agreed. Okay. So if the seller, if it's a hedging, okay, we are looking at a situation where we are hedging. If we're hedging, the seller has this asset. Okay, he has the asset, say the bond. He agreed 12 cedis. Bond and agreed 12 cedis. Now, on the day, and in December 2026, the price had dropped to 9 cedis. The difference is the seller or the owner of the bonds losses. That 3 cedis. So the person loses or 3 cedis. Now, when it is pure speculation, people are using derivative instrument. What they do is that this person may not have the underlying assets. Now here he loses just 3 cedis. He will sell this. The buyer can take it, the contract. Okay. And then he will get the 9 cedis. So the person just lose. But if the person does not have any assets to sell at 9 cedis to offset, the losses will be purely 12 cedis because that person doesn't have the asset to sell at 9 cedis. He just wrote a contract that I will sell something that I don't have to you. The person and agreed at $12. So when it doesn't work and then price fall, when the price fall, all that the person will have to do is to pay all, is a speculator, pay all the $12 to the buyer for each say bond that contract that he wrote. But if the person has the bond, you pay, you will sell at 9 cedis. Sorry, you will pay the $12, but can still sell the asset at 9 cedis in the spot, at least to offset the loss. So the actual loss is 3. That's why we say that hedging is meant for risk management. Though a loss may happen, but it is meant the loss is minimized. When you are hedging with an underlying asset where the hedger has the asset or own the underlying asset. But if a pure speculation, the person doesn't have the asset, he will write a contract that I will sell something that, say, for instance, you may go and agree that you sell a car to somebody. Let me come to that level. You will sell a car to somebody at, say, 100,000 Ghana cedis. You don't have the car. The person agree that in June, that is what I'll pay. You don't have a car, that particular car. Now, in June, the price of the car has shot up to, say, 1.5 billion. The person says, bring the car. You have written and promised somebody that you give the car at, say, 100,000. But meanwhile, in June, the price in the market has gone to 12,000. You don't have it. Let's say 1.5 or 150,000. What do? You are going to buy the car at 150,000 and go and give the car to the person you held that contract with. And so there you lose. But if you have the car and the person says that you agree to sell the car in, say, in June at 100,000. Now, when the person says deliver the car in June, you can deliver the car having the car. Even though the price in the market are gone to 150,000, but your only loss there is 50,000. You can deliver the car at the 100,000, even though if there weren't any contract, you would, or you could have sold the car at 150 in the market. But because they had contract to deliver the car to somebody at 100,000, at 100,000, you just give the car to that person, and then you lose the market rate, the difference, which is our 50,000. So that is how in the market really it is when it comes to speculation and other things. Now, and so that's why when you are not having that, don't enter. We advise managers and business not to enter into derivative instrument, even though people can speculate, because just like lottery, it can speculate. So for the forward price, that is the mechanism. The forward price for the contract is the delivery price, okay? And this is, it will be applicable to the court if it were what negotiated today. It is the price today. You go and sit with the potential buyer of the contract, and you negotiate today, and this price will be applicable. What you agree will be applicable at the expiration date or the future date that you agreed in the document. Okay. One thing that you have to know that the forward contract may also be different. Okay, the price of the forward may be different from one contract or to the other. They are not depending on sometimes their maturity. Okay, one is having 6 months, one is 5 months. The value wouldn't be the same. Okay, the value wouldn't be the same. Now, there are certain terminologies that we have to get used to as we move on. We have what we call a long position. This is the party that agrees to buy an asset in the future, okay, with a contract. A party having a contract to buy an asset in the future. And then we have a short position, okay? The one that take the short position also have a contract to sell an asset in the what? In the future, okay? And most of the time, when it particularly comes to short selling, it involves selling an asset or a particular security, and it's a common practice in the derivative market where certain speculators can borrow a security from a broker and sell it today. They do not own, most often when they are taking the short selling, the sellers do not own the asset, they don't own the asset, but they can borrow the asset from someone who has.
Yeah.
Yes.
Please, when are we closing?
It depends on, because I think we started late, but I don't know. Is it Joyce?
6:30, please.
Okay, 6:30. Joyce, but I ask you that if it's possible, we can have on the normal day some meetings in the evening. I don't know if you are discussed with your class.
So we want to discuss with you so that if you want us to decide to, we can do so and get back to you.
I want you to, for instance, should I put Wednesday? Then Monday I have other lectures class, but Wednesday, okay, if we can have evening after work, after you have close work, I know that you are working, so that we can look at some of the issue before we meet face to face. So we can look at Wednesday. I think Wednesday I'm lesbian. Monday, Tuesday, I think I teach in the evening.
Okay, sir.
Okay. So the short selling is a trading strategy where an investor borrows a share or a bond, or it can be generalized a particular assets. You just borrow, okay, and sells them in the open market. So the short seller doesn't have the asset in his name, doesn't own it, can see a broker and borrow the asset, quickly come to the market on that same day or in that same time and sell it with the hope that price will drop in the future. And then when price drop, he'll buy it cheap and go and pay it back or replace it or pay to the lender. I hope you are following the strategy. Yes. So normally we say that it is based on leverage. You don't have the short seller. Take yourself as a short seller. You want to sell a particular security. Let's say a bond. So you go and see a broker. Then the broker will lend you or contact another say owner of a share or a bond and lend it to you. But normally you pay a fee, small fee. Because normally in this market, there are premium for some of this thing to okay. A fee for some of this thing, okay. It's just like going to bank, you want some loan to do something. I mean, you have to pay certain transaction fee. certain charges. They call it what the commitment and other fees. Okay, so in that same market, that's happening. They normally call the premium. So pay a charge for somebody to lend the security to you. Okay, now so the security will be lent to you. If it's a share, normally when they lend to you, you'll be required to pay dividend to the true owner who lent you the asset. If it's a bond, you also prepare to pay a coupon or certain interest to the lender. So temporary, on that same day, you borrow and own an asset. Okay, you just borrow. You borrow it, and then quickly you sell. Now you agree with the lender of the asset, maybe that you replace it in 3 months' time. And you do so or come out with this trade thinking that price of the asset will fall. So quickly assuming that the price is today in the spot when you're doing the agreement, the price is say $10, or let me quote in cedis, 100 cedis per the security or share. Okay, and sometimes when we are doing it, we just use one say share, one bond, but it could be multiples of them. Bonds can be, or share can be owned in multiples. Okay, so you negotiate, and maybe the price is 100 cedis now, and then let me cite some of you in the class. We have Bismarck. Bismarck want to take a short position. So what Bismarck will do, Bismarck will go and see, say, Jane, and borrow Jane's security or bond or share. Okay, you go and borrow and pay certain fee. But they will agree, Bismarck and Jane will agree that Bismarck have to return the bonds or the security in 3 months' time. Okay, you have to return it. Now, immediately Bismarck gets the bond or any security from Jane, that same day, assuming that the price is 100 cedis, that same day, Bismarck will sell, or that same time, to somebody and sell it 100, if you like, the same price, 100 cedis. Get this money and pocket it. You can even go and put it in a bank. Now, when we are working, we come to practice. When we meet board and we are doing the calculation, we see after he has sold it, Bismarck can even go and also invest the money somewhere and get interest on it. After all, you have gotten the cash out of borrowed stock or security. You borrow it, it doesn't belong to you. It belongs to Jane. Jane doesn't want to sell it. He wants to keep, because he has a view that price will be the same or price will go up. Now, when price goes up, then Jane will sell. But Bismarck had done its analysis with your expectations. You have done your intrinsic analysis and everything, and determine the price that in future the price will rather fall. So you go and negotiate with the Jane. Jane, can you lend me about 100 shares, which one may be 10 pounds or whatever. So Jane will do that. Quickly, Bismarck will go and sell it to somebody. Okay, maybe Foseni, he will sell to Foseni. Foseni then get it and go. Now, in 3 months' time, there will by all means a price for that same stock in the market. So if Bismarck's anticipation or forecast is right, maybe the price will drop below 100 cedis. It comes to say say from 100, it comes to say 70 cedis. then Bismarck can buy that same security, which is sold to, say, Husseini at 100 cedis at 70, and then come and pay it back or replace it and registered it again in the name of what? Of Jane. And that is where they replace. So in this case, this short selling, if that works, then Bismarck gets a gain. But if price rather goes up, then Bismarck will lose. Because in the market, assuming that it goes to, say, 150 cedis, then Bismarck will have to buy 150 cedis and come and replace it or give it back to J. But it's a way in the market as this goes on, because price, if it is on exchange, price keeping what do you call it? Investors in such or participants in such market keeps on monitoring the trend. And if you think that is not in fact, you take a long position to counter your short selling. You take opposite position. That's all. So Bismarck initially took a short position. When you think that prices are moving and its predictions on the distance is wrong, all that Hussein has to do is to take a long position, which to counter his exposure. And when they are due in the same month, whilst he's buying, what do you call it? He's buying to sell or give back to Bismarck. Somebody may also be the one that is taking the long position will also be paying for that cost. So it really, there are a lot of strategies in the market that helps to hedge. You can take long against a short position if you think that your exposure, and you go and buy another contract to offset it. Okay, that is what happens in the market. It is quite interesting. So these are some of the steps involved. Okay. The borrower, in this case, there's one person borrows the shares, okay, from a broker. And most of such investors have their own brokers. Then the borrowed shares is sold at the current market price and get the money. You can even invest it in another kind of investment. Go and buy fixed deposits. Go and buy, say, the some of these strategies and straddles that occur. As you go deep into this and into that, as you go deep into this, there are a lot of strategies that can be combined. One that is somebody can go and buy risk-free asset like T-bill and get some earnings on it. Okay. And then later on, wait for price to drop. Wait for price to drop. If price really drop, the person gets interest rate returns. If the person, the short seller had really invested the money somewhere, even the money market. And then you also get again in the fall of the price. Okay. Now, so the short seller would then buy back when the price fall and then return the shares to. That is the strategy of short selling in the market.
Hello, sir.
Yes.
In the case of shares, assuming you buy or you go and borrow, you go and borrow from someone,
yeah,
and you sell that particular shares, hoping that prices will drop for you to buy and replace.
Yeah.
In the situation of capital gains, how does it affect you, because you are not the original owner of that particular share? So
yeah,
how does it
Yeah, because you don't own, you don't gain, you never get any, that short seller doesn't benefit from any capital gain. Because this thing is not registered in his name, right? Even if they say he pay dividend to the lender, that is the practice. So there's no capital gain here. The only benefit that when the person sell it to get the cash, you invest it at equivalent what? Required rate of returns in the market. That is a strategy. Purely investor, that's what they do. You receive the cash today, you know, as part of good financial management, you don't keep cash just in an ordinary savings account or in your pocket. Okay, so pure investor, those are investment-minded persons. Basically, they don't leave any money in their account. Okay, so when they sell it, another benefit is what I said earlier on. They are also going to use it either to buy another instrument, especially risk-free, the one that this thing is what do you call it? The returns is sure. That's what they do.
Hello, sir.
Yes.
So in a situation where let's assume that all these movements are tracked. Now, capital gain tax, does it not affect the original owner of the share? Because for the person coming to borrow it is not going to pay that tax on it because the share is originally registered in.
Yeah. But the person that also learn it, okay, the person that own it will get a capital gain, okay, but he also anticipates that price will go up. So that's why the person doesn't release that in outright or sell outright to say to the borrower person. He still has interest and want to keep it. Okay, but I still want to really benefit from, say, manage his risk. So the capital gain, after the capital gain, the tax will be paid by the original owner of the share.
Thank you, sir.
So this is an example. I just give an example, then we close. Okay. Let's say an investor believes that the company ZYS stock, currently trading 100 cedi per share, will decline in value. Okay. The word beliefs here is rational beliefs. In final, that's what you have to. It is not prophecy, and it is not speculation or whatever. You should have a calculated belief. So he believed that current trading a share that's 300 per share would decline. So how would that investor take a short selling position? First of all, you borrow and sell. The investor borrows, say, 100 shares and sell them at 100 cedis each. And that investor may get 10,000. That is 100 times 100 shares. The price is, each price is 100 cedis, but he borrows 100 shares. Now, when he borrows 100 shares and sell, the person gets 10,000 cedis. Okay, each of these 10,000 cedis also will be reinvested somewhere. Okay, now when the price drops, what happens? Assume that the price drops to 60 cedis per share. That means that the individual can buy the 100 shares at the cost of what? 6,000. Okay, 6,000. Come and replace it. Okay, he plays it. Now, what is the gain of the short seller? The person initially, assuming that there's no investment, the person doesn't even didn't invest the proceeds. Then the person, the short seller, received this, okay, and then buy this back. He gets a benefit of what? 4,000 cedis. Okay, on the short seller. What the true owner will gain is, in this case, is the premium that they have to pay or the charges that they have to pay. Okay, so here in practice, we have not also deducted the premium costs. Okay, some of them may be very expensive, and this will be paid to the lender. Assuming if the lender is a broker, then you pay that. It is also another form of investment for the true owner of the share. He receive a premium and then also receive dividend, whilst he still owns the share. Okay, and this is some of the products that's happening in the market. So this is just to demonstrate short selling and the rest. We'll come back to the forwards, and later on when we meet, I think the time is up. Now I will share the materials with you. I think I have to upload a lot of them and an assignment for you. So thank you for a meeting. We'll have to talk to your. We meet Wednesday, all team Biko, by the grace of God, and then we finish this slice. So thank you.
Okay, Dave.